Welcome back, everyone. Today, we're jumping right into the hot seat. We are stepping directly into the shoes of a corporate finance treasury manager. Together, we're going to explore how to navigate one of the most high-stakes, nerve-wracking environments out there, the wild, completely unpredictable global financial markets. You see, as a treasury manager for a massive multinational corporation, your job isn't to gamble. Not at all. Your job is to protect the company's hard-earned cash from forces that are completely outside of your control. So think about it for a second. How do these massive companies actually survive when global markets are just swinging wildly from day to day? Imagine you're running a business, right? And suddenly, out of nowhere, a completely unpredictable geopolitical event causes a massive spike in commodity prices. Or, say, a central bank decision on the complete opposite side of the world causes your local currency to absolutely plummet. Just like that, your carefully planned quarterly margins are ruined, literally wiped out. It's a terrifying prospect. And honestly, it's the exact problem we are solving today. Okay, let's dive into this. Here is our roadmap for this explainer. First, the threat of volatility. Second, enter the forward contract. Third, hedging commodity risk. Fourth, hedging currency exposure. Fifth, counterparty and liquidity risks. And finally, the Treasury Manager's Playbook. Section 1. The threat of volatility. Business margins at risk.
Volatility is, without a doubt, the ultimate villain to a corporate balance sheet. I mean, the threats are literally everywhere. You've got unpredictable commodity prices. Just think about an airline trying to budget for jet fuel when oil prices are jumping all over the map. Then there's sudden currency depreciation, which is just a massive nightmare for any importer. Add in unexpected interest rate hikes for companies that need to borrow, and the result? Routine, massive disruptions to cash flow forecasts. If multinational firms, like big IT giants or global airlines, leave their procurement and currency exposures completely to chance, they risk catastrophic, unrecoverable losses.
Moving right along to Section 2. Enter the forward contract, the ultimate corporate shield.
Let's break this down really clearly because every single word here matters. A forward contract is a customized, private agreement between two parties to buy or sell an asset at a predetermined price on a specific future date. Now, notice those words, customized and private. This isn't some standardized trade you'd find on a public stock exchange. No, this is an over-the-counter, or OTC, contract. It gets its value from an underlying asset, like a currency or a commodity. And guys, here's the real kicker. Entering into this agreement usually requires zero initial payment. You are simply making a legally binding promise for the future.
In any forward contract, you've got two parties locking in their specific advantages. It's kind of like a seesaw. If you take the long position, you're the buyer. You agree to buy the asset later, and you absolutely benefit if the actual market price skyrockets above that price you locked in. On the flip side, the short position is the seller. They agree to sell later, and they benefit if the market crashes below that locked-in price. Basically, someone is locking in their cost and someone else is locking in their revenue.
Section 3. Hedging commodity risk, the airline scenario.
Okay, let's do a little role play. Imagine you're the treasury manager for an Indian airline. You're looking at the geopolitical landscape and you are completely terrified that jet fuel prices are going to skyrocket over the next 6 months. And let's face it, you cannot run a business not knowing what your absolute biggest expense is going to be. So what do? You enter into a forward contract to lock in a price of exactly 80 rupees per liter, payable in 6 months. Boom, you can finally sleep at night. At zero initial cost, you've just bought your airline absolute cost predictability, completely regardless of what the market decides to do.
Now, the absolutely crucial point here is understanding the double-edged sword of this legal obligation once those 6 months are up. Let's say the market goes crazy and fuel hits 95 rupees a liter. Well, the airline is popping champagne. They successfully locked in that lower 80 rupee rate, completely avoiding a massive margin-crushing cost. But what if the market drops to 70 rupees a liter? Well, the airline effectively loses. They are legally forced to pay the 80 rupee rate they agreed to, missing out entirely on the cheaper fuel. But remember, and this is so important, the goal for our treasury manager isn't speculation, it's certainty. Part 4. Hedging currency exposure, the importer scenario. Let's switch gears to another high-stakes situation. Imagine an Indian smartphone importer. They need to pay a U.S. supplier $1 million in exactly 3 months. The current spot rate is 83 rupees to the dollar, but they are terrified the rupee is going to weaken. So they lock in a 3-month forward rate of 84 rupees to the dollar. And this brilliantly illustrates exactly why they do it. Look at the math. If the rupee weakens to 88 without a hedge, they're suddenly on the hook for 88 million rupees. That's a total disaster. But with the forward contract, their payment is perfectly capped at $84 million. Yes, if the currency strengthens to 80, they still pay 84, but they have completely eliminated the risk of a catastrophic loss. Which brings us to the absolute core motif of corporate finance. Hedging is about sacrificing potential gain from favorable market moves to achieve strict financial predictability. Our smartphone importer willingly gave up the chance to pay only $80 million just to ensure they would absolutely never have to pay $88 million. Hedging isn't about trying to make a quick profit off the financial markets. It's about paying for the peace of mind that your company's quarterly budget won't get destroyed by some random sudden currency swing. All right, Section 5, Counterparty and Liquidity Risks, the reality check. Any seasoned Treasury director will tell you that forward contracts are amazing, but they come with serious dangers you have to watch out for. First off, there's opportunity loss, which we just talked about. You willingly miss out on favorable price moves. Then there's illiquidity. Because these are completely custom contracts, it's very difficult to exit them early if you happen to change your mind. Furthermore, unlike standardized futures traded on a massive exchange, forwards have no daily settlement. That means massive unseen losses can accumulate silently over the life of the contract until maturity. But the biggest danger of them all? High counterparty risk. I really want to punch in on this terrifying reality for a second. Counterparty risk is the risk that in a private, over-the-counter trade, the other party might just go bankrupt or default before the settlement date. With an exchange-traded future, the exchange guarantees the trade. But a forward? That's just a private agreement between two businesses. If you lock in a great price to buy jet fuel and your supplier goes bankrupt on month 5, your customized shield completely vanishes. Poof, leaving your business totally exposed to the spot market anyway. Finally, Section 6, the Treasury Manager's Playbook, Execution and Strategy. Let's look at the complete life cycle for a hedge, the step-by-step reality for a Treasury department. Step 1, Day 0. You establish your customized OTC contract. Remember, you tailor the quantity and the terms perfectly to your business needs, all at 0 initial value. Step 2, the holding period. You monitor the spot prices and the underlying carrying costs. And you keep a very close eye on your counterparty, since there's no daily settlement to clear the books. And finally, Step 3, Maturity. You settle the contract. You either take physical delivery of the asset or you make a cash payment, strictly at that locked-in price. Listen, if you take absolutely nothing else away from this explainer today, please take away this one guiding philosophy. Hedging isn't about making a profit. It's about achieving predictability and managing business risk. Whether you're an airline buying fuel, an IT company managing foreign receivables, or an importer buying electronics, the forward contract is your tool to strip the uncertainty out of the equation. That way, you can focus on actually running your business. And that brings us to the ultimate question you have to ask yourself, or really any financial leadership team. Are you successfully hedging your business risks, or are you just gambling on tomorrow's market? Because leaving your massive expenses exposed to the whims of spot prices and global currency fluctuations, well, that isn't business strategy. That's just rolling the dice. Thank you so much for exploring the fascinating world of forward contracts with me today. I hope this gave you a powerful understanding of corporate treasury risk management. Until next time, keep learning and keep exploring.